Okay, let's jump right in. There's a really serious warning we need to talk about today. We're looking at analysis arguing the entire global financial setup. The huge derivatives market, even our paper money, it's potentially facing a massive systemic shock imminently.
That's right. And this isn't just the usual talk about inflation or commodities going up. We're looking closely at veteran economist Alasdair Macleod's view here. He sees this as the end game for the whole credit-based era.
The final act, really. And he's saying the place to watch this unfold isn't like the usual economic reports.
No, exactly. Forget GDP for a minute. He says, look at gold, look at silver.
Hmm.
We're pulling together his thinking on why these metals are, as he puts it, signaling the dying days of the fiat currency system.
Okay. So our goal here is to make sure you really get what these signals mean. By the end of this, you'll understand why Western players are losing their grip on metal prices, what specific leverage risks could actually trigger a crash, maybe like 1929, and why Macleod is so insistent that physical gold and silver aren't just investments. He says they are money.
It's a critical point. And look, before we get into the mechanics of it all, if this kind of analysis, this synthesized view, is important for how you navigate things, please take a moment right now and subscribe to Sierra Via. It's genuinely the best way to keep getting these insights.
Definitely. Okay, let's unpack this physical market reset Macleod talks about, this West versus East shift in power over pricing.
Yeah, it's a huge change for decades. Western markets think COMEX in New York, the LBMA in London, they pretty much set the price. They used paper contracts, highly leveraged ones, to kind of manage, or some would say suppress, the real price of gold and silver.
Right, creating supply out of thin air with futures contracts, basically hiding the real demand.
Exactly. But Macleod argues that system is breaking down. Control is slipping.
So why Shanghai? What's different there?
It comes down to physical reality. In the East, Shanghai especially, delivery means delivery. It's a physical settlement system. You can't just roll paper contracts forever like you often can in the West. If you buy gold, you expect the actual gold.
And that forces the real supply and demand picture out into the open.
And right now, that picture shows demand is just overwhelming the available physical supply.
We're seeing the signs, aren't we? Gold hitting nominal record highs, silver showing crazy volatility, stuff we haven't seen since, what, 2011?
Yes, and Macleod stresses this isn't just speculation about interest rates or something. It's driven by real physical shortages. Even big Western banks, UBS, JP Morgan, Citi analysts, they're acknowledging this scarcity now.
And the proof is in the inventory levels, the vaults.
Absolutely. Western vaults are thinning out fast. COMEX registered vaults, the ones with metal actually available for delivery, they're draining. And the amount of metal being demanded, physically taken out, is staggering.
How much are we talking? Give us a sense of the scale.
Okay, so this year alone, we're looking at over 1,000 tons of gold and tens of millions of ounces of silver that have been stood for delivery. And just to be clear, standing for delivery means someone holding a paper contract actually demands the physical bullion. They're pulling the metal out.
They want the real thing, not the promise.
Precisely.
And China's role in this is key, isn't it? They mine a lot, but they import and accumulate even more.
Hugely important. For years, they've been accumulating massive amounts of metal. Macleod suggests that maybe China used its influence to keep prices down in the past, to buy time and build reserves, but that strategy seems to be over. Now they're accumulating silver too, and that's adding to the shortages.
Which leads to this other really startling point Macleod makes, the failure of Western institutions to prepare.
It's shocking, really. You look at these huge Western fund managers controlling trillions. They're loaded up on tech stocks, bonds, but their exposure to physical metals, it's virtually zero.
They're completely offside if a monetary reset is coming.
Totally unprepared. And this leads to a stunning calculation Macleod did. He worked out that if just 1%, only 1% of global investment portfolios decided to shift into gold,
Okay.
that would require 25,000 tons of physical gold.
Wait, 25,000 tons. How much is that relative to supply?
Well, think about this. The entire world mines maybe 3,000 tons of gold a year. So a tiny 1% shift in portfolios demands something like 8 years' worth of global mine supply. And Macleod's warning is stark, that metal just doesn't exist outside of Asia's control anymore.
Wow. So when the big institutions finally wake up and want in,
They'll run straight into a wall. There won't be physical supply available in the West. It's a collision course.
the physical drain, the institutional gap, that's the fuse. Now, let's talk about the dynamite it's attached to, the global credit bubble.
Yeah, but just before we dial into how this physical situation could ignite the whole paper system, let me just quickly say again, if this analysis is giving you a clearer picture, please support this work by subscribing to Via. It really helps us keep bringing this to you.
Right. Okay, argument 2, the fiat crisis. Macleod insists we're looking at this all wrong. It's not just prices going up, it's the actual value, the purchasing power of our paper money going down, collapsing.
That's his central point. The market keeps hoping inflation is temporary, that central banks will fix it. Macleod says no, that's wishful thinking. The problem is the currency itself.
And the bigger picture is that our whole modern monetary system isn't built on, say, production, but on debt, on a massive credit bubble.
Exactly. And the scale is just mind-boggling. The derivatives market estimates put it over $2 quadrillion.
2 quadrillion? How does that even compare to the real economy?
It dwarfs it. Global GDP, all goods and services produced worldwide in a year, is under $100 trillion. So this market, these side bets on price movements, is potentially more than 20 times the size of the actual global economy it's supposedly based on.
And it all relies on trust, doesn't it? Trust that everyone involved in that web can and will pay up.
Purely on trust. And underpinning that trust right now is absolutely unprecedented leverage.
The leverage bomb, as you called it earlier.
Yeah. FINRA data shows margin debt in stocks alone is over $1.2 trillion. And what's really scary is how much that's grown. It's like 4 or 5 times higher than it was just a decade ago. The risk is concentrated.
But why would regulators let it get this high if it's so obviously dangerous?
Well, Macleod's take is that the system is basically addicted to credit. The regulators are kind of trapped. They either can't or maybe won't really tackle the deep structural leverage.
Which raises the terrifying question, what happens when the market turns down?
Macleod warns that even a standard correction, say 20–25%, which isn't unusual, could instantly vaporize those leverage positions, force selling, margin calls, a cascade, like 87 or even 1929.
And the contagion risk.
Yeah.
If the metals derivatives market sees major failures.
It doesn't stop there. The big players, the bullion banks, they're the counterparties across all derivatives, markets, commodities, currencies, interest rates. It's all interconnected.
So a problem in gold or silver could spread everywhere.
Instantly. It could unravel the whole system. Which is why, Macleod expects, we won't hear about the failures initially. He anticipates quiet rescues, behind-the-scenes bailouts when a big bank or their client gets into trouble with metals.
Keeping it hush-hush to prevent panic.
Exactly, to maintain confidence. But
every secret bailout just proves the system isn't sound, right? It shows it can't handle the truth, basically. It's running on fumes, on dwindling trust.
it exposes the fragility. And this is where it gets critical for everyone listening. Macleod foresees an inevitable collapse of confidence, maybe triggered by a failure to deliver physical metal somewhere in the West. And when that happens, those huge investment funds holding zero gold, they will panic.
Not an orderly shift, a stampede.
A frantic flight out of paper into physical bullion.
But we just established the physical bullion isn't there, not in the West anyway.
Correct. So you have massive panic demand crashing into non-existent, readily available supply.
Prices don't just rise.
They go through the roof, as Macleod puts it. The crisis jumps from being about commodities to being about the currency itself. The whole monetary system resets.
And it's happening faster than people think.
He believes so, and his final point really cuts through the complexity. He says, essentially, gold isn't rising, it's the value of paper that's falling. Gold and silver are just reverting to what they've always been. Real money, the only kind that doesn't depend on someone else's promise or creditworthiness.
So the provocative thought Macleod leaves us with is this. When that faith in paper finally breaks, it's not if, but who gets stuck holding the worthless paper promises, and who ends up holding the actual metal.
That's the stark choice in the reset that seems to be unfolding.
The urgency here feels palpable. To stay ahead of these shifts, to understand what's happening, please make sure you subscribe to Via. It's vital right now.